warm welcome to the AgFirst financial survey results for 2020. My name is James Allen, Managing Director of AgFirst Waikato, and it really is our pleasure to host you today and provide a bit of insight as to what's been happening over the last year in both the sheep and beef and dairy sectors in the Waikato, Bay of Plenty, Central North Island. So for the first time ever, thanks to COVID-19, like many presentations, we're running this on a digital platform today. So bear with us as we get used to this as much as you do. And a special thanks to Dairy NZ for letting us borrow their platform today. That is greatly appreciated. So AgFirst has been running the financial survey since 2013, in which themselves were a continuation of the MPI MAF farm monitoring surveys. This means we have a very powerful data set to make long-term comparisons against. So our team and our clients use this information throughout the year to benchmark their operations, to make informed management decisions and review industry trends. We will be more than happy at any stage to discuss the results of this survey with you in person and in more depth. So today we have on my right here, we have Phil Janot presenting the Waikato Bay of Plenty dairy model, then Stephen Howarth presenting the Central North Island sheep and beef model. The format for today, Phil will run through a slideshow presentation of approximately 15 minutes, followed by Stephen presenting the Central North Island sheep and beef model, once again about 15 minutes. Then we've also allowed around 15 minutes for questions. So all of the guests are on mute today, so please do send us your questions via the chat site or the question site on the platform here. We've got a team member collating those questions and we'll come back to them later on. The reports themselves will be available on the AgFirst website either later today or if not first thing tomorrow morning, as will this entire presentation, free for you to download and peruse at your leisure. So join with us now and I'll hand over to Phil Janot to kick us off with the dairy results for the previous year. Phil.
Thanks, James. Hi, everyone. I'm Phil Janot, ag economist. I sort of oversee the financial survey program, particularly the dairying side of things. So just bear with me 10 secs, I'll load things up. Excellent. So as James mentioned, what I'd like to do is talk about the Waikato Bay of Plenty dairy side of the program, if you like. And then just to run you through the process, what we do is we get out and monitor 25 farms across the Waikato Bay of Plenty regions. That's done through June. What the team does is collect the financials for the year just finished, which is 2019-20, and then do a forecast budget for the upcoming year, 2021. Those are then collated together into a draft model budget, which we then have an industry meeting to discuss through the results and just make sure we're on the straight and narrow. The model itself, which I'll show you in 10 seconds, is based on industry statistics, so it represents the average or mean of the regions in question. That's the model structure, which hopefully you can all see. Just to give you some past years' data, but in essence, it's 129 hectare property. We winter 364 cows, milk around 360. And normally we produce around the sort of 130,000 kilos of milk solids, depending on the season. In terms of 1920, as you can see the table at the bottom there was a slight reduction in cow numbers from the previous year, and in particular our production was down because of the drought. Regionally, that averaged out at minus 4.1%. In terms of the year coming up, 2021, our monitored farmers weren't really looking at altering cow numbers at all. They were quite optimistic on milk solids production. On average, most of them were budgeting on at least a 5% increase, which we've moderated back to a 3% increase, mainly on the basis that in all previous droughts, we've never entirely recovered the previous year's loss, if you like. So that gives you some idea of the model farm, if you like, and then just looking ahead to the end of this coming season, again at this stage, not a lot of change in terms of stock numbers. Looking back at the season just past, which you'll be well aware of, really, we had a mild winter this time last year, which was very good because we'd had a dry period just before that. We then had a relatively wet but mild spring, reasonably good pasture growth, and then, as you know, we ran into a very dry summer and autumn. Most areas, the rain finished or stopped prior to Christmas, and most areas didn't get decent rain again until late April into May, and sort of North Waikato, Hauraki didn't actually get good rain until well into June. So as I mentioned, overall milk solids production down 4.1% across that's weighted average across the two regions. Maize, which was an important supplementary feed input, if you like, again directly affected by the drought. On those soils with good water holding capacity, yields were still good, but on the lighter soils, yields were well and truly down. Net cash income for the model was up 10% compared with the previous year, and that's really on the back of both an improved payout and good beef returns, which offset the drop in production. Because we had good income, farm working expenditure also increased, especially on feed costs, which is a direct reflection of the drought. A bit more fertiliser, particularly nitrogen this last autumn, and R&M. Our debt servicing costs were down 11%. That's a combination of lower interest rates and the fact that the model has been paying back some debt over the last 2 or 3 years. So the net result, if you like, is that our farm profit before tax was up 39% compared with the previous year. So looking good. So going into 2021, most areas have recovered well. We've had reasonably good rain and mild temperatures. So we had good pasture growth, and pasture cover is actually quite good. Again, the exception probably the sort of Hauraki area, which didn't get rain until much later. Had some nitrate poisoning as a result of the rapid growth, and some farms have lost cows. A lot of cows, of course, were dried off early, so going into calving, which is happening right now, most in very good condition. Farmers obviously used a lot of supplement during the drought. Our estimate is most farms are at least half a tonne of dry matter per cow down on supplement, but in talking to our monitored farms, most were quite confident they had enough supplement on hand to get through into the spring. A bit of a downside, if you like, young stock, low target weights, again, a direct result of the drought, and that is actually quite a common occurrence. These regular droughts are seeing young stock not growing particularly well. And we've still got an issue, and I'll come back to that later. Despite the fact that we've had good rain, in a lot of areas the subsoil is still quite dry, which doesn't particularly augur well if we get hit with another dry summer this coming season. The model works on a cash in, cash out basis. So as you're well aware, in the dairying industry, you've got your advance payment for the current season, and then a deferred payment coming through from the previous season. So what this graph just shows you for the different years is the proportion of advanced and deferred. And then the red line there is the average, which over that period, which is what we're talking here about 12, 13 years, is $6.11. The other key thing, if you like, is going back to the dark days of 2015-16. Since then, over the last 3 years, we've now had good plus $6 payouts, and the expectation at this stage is that it's going to be repeated for this coming year. For the profitability trends for the model, again, it gives you what's that, about a 15-year period. So the blue bars, net cash income, the green is our farm working expenses, red farm profit before tax, and the yellow is the farm surplus for reinvestment. So the yellow bars, one of the more important ones, if you like, that indicates the cash that we've got available for things like capital expenditure, development, debt reduction, etc. And again, if you look at that, you'd be well aware that the bad year we had in 15-16 since then, and particularly the last 3 years, farm's been operating well. We've had a good farm surplus for further expenditure, if you like. And again, the expectation is that's going to be reasonably similar for this coming year. Where the money ends up, it's a bit of a complicated graph, if you like. So the yellow is our farm surplus for reinvestment. The green is capital, or light green. The red is debt repayment, purple development, blue dividends, which is income, of course. Green new borrowing, and the dark blue net cash position. So you work that along, if you like. Key things there is, if you look at the red bar, the model has been paying some debt back over the last few years. Only in this last year, 1920, have we had a sort of a full debt repayment, a table mortgage equivalent, if you like. And then looking at this year, 2021, you'll notice our borrowings and our development are very high. That's really a reflection of a wider trend throughout the industry, with a lot of farms spending a lot of money on putting in new effluent systems, upgrading the cow shed, putting in a lot of new tech. So if you like, we decided we'd bite the bullet and reflect that in our model budget for this coming year. This slide looks at the break-even payment required. Again, this is the figures are direct from our model. So in terms of break-even, what I'm talking about there is in terms of the farm business, you need to pay your farm working expenses, you need to pay your debt servicing, you need to live, which is your drawings, you need to cover your depreciation. It's not a cash cost, but if you're not covering that, you're winding down your plant and equipment. And of course, you've got the good old tax man. So that's the sort of the bold line, first bold line there is the amount of money needed to cover that. If you take off the income coming from your cattle, your cull cows, the shaded line is the milk solids payment that we need to cover all those expenditures. And then just below that is the payment we've had within each season and the difference below. Again, if you look over the last 2-3 years, we've had good or above break-even payouts, if you like. And again, the expectation is the same for this year. In the wider sense, if you start looking along those figures, we really need around that sort of high $5 to $6 payout to break even, and we need, a payout well north of $6 if we have to pay or repay debt, cover our capital expenditure, that sort of thing. Just another thing to note on that, if you look along the interest line, that figure has been steadily decreasing, which is a direct reflection of both interest rates dropping and the fact that the model has been paying some debt. Just a slide to show you farm working expenses as a proportion of net cash income. Whatever it is, brown line there is the average over that period, which it sits at about 61%. In other words, 61% of our gross income is going to cover our farm working expenditure. And again, if you look over the last 3-4 years, we've been sitting pretty at or just below that average. This slide shows you where our farm working expenditure is. The yellowy line's labour, green is feed, red fertiliser, purple repairs and maintenance, and blue, light blue overheads, so that's rates and insurance. So a number of things there. The first one, which is obvious, is that our feed cost is our if you like, single biggest cost, sits around 30+% of our total farm working expenditure. In terms of feed, that's supplements made on the farm, supplements bought in, and it also includes the cost of grazing, young stock off the farm. Next one, the biggest or single biggest cost is labour, which is fairly static across the years. A slight bulge in the middle there is due to the fact that not so much labour costs went up, but our income came down, so the proportion altered. And the third biggest expenditure is our overhead, so that's our rates and insurances and all the rest of it, which tend to only show a one-way trend in terms of increasing in cost. Now, we talked about this a little bit last year in terms of the impact on our balance sheet. What that graph shows there is over the sort of period 17-18 through to 18-19, the model balance sheet's taken quite a big hit, and that's very largely due to a reduction in land values. Now, they vary considerably around the region, as you know, based on the location. But over that period, our models lost $1.8 million off its balance sheet, largely due, as I say, to land values and a bit of a loss on the Fonterra shares as well. Our equity in green has also taken a hit, not quite as much, 1.6 million, and that's mainly due to us, or the model, paying off some debt over that period. The land value data we've got from the real estate industry would show that land values have tended to level off a bit over 1920, and hopefully that'll be the same through 2021. So, as I say, taking a hit, hopefully not too much more. So just to sum up where we are financially in terms of our model, as I've talked about over the last 3 years, and again looking forward for 2021, the farm's been operating quite profitably. We've had full farm working expenditure, we've been paying tax, we've had reasonable level of capex expenditure, and we've been repaying debt. So in that sense, the farm's running well. Again, as I mentioned, the unfortunate thing, or the downside, if you like, is over that period, the balance sheet's taken quite a hit, but hopefully leveled out now. So I just wanted to finish off with 2 or 3 other points. COVID-19, well aware. The lockdown itself didn't have a major impact on most of our farms, if you like, apart from the fact you couldn't shoot into town that readily. Going forward, though, there are some issues there. There's certainly issues around sourcing labour. And you'll be well aware of the problems of getting immigrant labour in. Certainly, on some of the farms, partners who worked in town couldn't, and that had a bit of an impact. And going forward, there's still a concern out there that, just looking at the worldwide situation with the pandemic, there is a degree of uncertainty as to exactly where everything's going to end up. PC1, or Plan Change 1, that really pertains to our Waikato farmers, or the farmers within the Waikato Waipa catchment. As you'll all know, there's a new plan's come out, which the council has ratified. It's off to the Environment Court. Again, there's some confusion and uncertainty there. There's a degree of confusion compared to, or with, the central government's freshwater plan and some of the things they're looking at there. Interesting talking to the farmers. Some of them were pretty much, been there, done that, whereas others were still with, PC1, what is it? I mentioned earlier around rainfall. As you can see from the figures here, the average rainfall is well down. At the moment, our topsoils are pretty wet, but the subsoils aren't. In one sense, we need a lot of rain over the next few months to make up the deficit. In another sense, we don't really want that since we're into calving and the season's underway. But if we do have a dry summer, it could be a lot worse than the one we've just been through. In terms of farmer confidence and sentiment, we've rated that as okay at the moment. As I mentioned, most farmers are reasonably happy in terms of the financial performance of the farm and where things are heading. But that's offset with that degree of uncertainty around politics, around environmental compliance, and around the impact of COVID on the world scene and markets. So I'll finish off there. That's just a picture of our report, which, as James mentioned, will be on the web tomorrow. If you have got any questions, happy to take them. If you send them in via the chat function, and we'll come back to them later. And in the meantime, I'll hand over to Steve to cover sheep and beef.
Great, thank you, Phil. So look, I'm a sheep and beef consultant, and I'll take us through the Central North Island Sheep and Beef Survey. So my presentation overview will be very similar to Phil's. I'll give a bit of background, firstly on the livestock schedules, then a bit of background on the model farm, then followed by unpicking the financials for the 1920 season, then the 2021 season, and we'll finish off with some other farm issues. So a bit of background on the schedules. Obviously this is a pretty key driver for sheep and beef farms. So what I've put up here is the 300 kilo carcass weight steer price. We've got the price per kilo on the left and the processing season running along the bottom line. Red is the 1920 season. So what strikes straight away is the spring. We had a brilliant spring pricing. Records were set. There was solid demand, especially coming out of China with the African swine flu depressing the production of pork, and the outlook was great. So when we broke for Christmas, we thought, hey, we could do no wrong. Everything was going fantastic. At that point, we didn't know about COVID, and there was some hints of a drought looming. So we can see the impact as we follow the red line through the summer, which, yeah, we certainly fell out of bed from where we were sitting. Price is sitting about $5.45 this week, end of July. And then we've got a dotted red line, which is our forecast, and then following through to next season with the dotted blue line. A lot of this will depend on COVID because there are still significant impacts on our overseas markets. I guess at the moment there is a backlog of product in the States, which they believe by September they'll be clearing. There's significant production from South America, Brazil, which has been redirected into China, which is a big driver there is because the local consumption has dropped through to COVID. And obviously the restaurant trade is a biggie here, with restaurants shut in certain countries. That reduces the consumption of the high value proteins, like the steak cuts from the steers. The blue line, that's a forecast really taking where the price sits now, and we're assuming that it will be depressed through next season with an impact of COVID. That's a big unknown. So we'll move on and have a look at lamb. So very similar profile with lamb, really. Brilliant record-setting prices through spring, and then falling quite sharply through summer, thanks to COVID and to the drought. So at the moment we're sitting on about a $7.20 schedule. And the big driver there, if we look forward onto the dotted lines, about half of our lamb is export lamb is supplied to the UK and the EU. So they're a big market, obviously, and there's falling consumption in those markets, which is one, a result of the restaurant trade, thanks to COVID, and number two, consumers swapping to lower value proteins, with the impacts of COVID, sort of people being more concerned about their budgets. So yeah, blue line, we're forecasting a lower price than where it has sat for the last couple of years. which obviously will flow into our model farm. So moving on to a bit of background about our model farm. So it's representing the central North Island hill country. So the red areas on the map there. We surveyed farms through June, surveyed about 13 farms, and then sat down with industry to sort of get industry views as well. And from those 2 points, we then assembled our model budget. So a bit of background on our model. So it's a typical hill country farm, 614 hectares, running a breeding ewe flock, lambing about 128%, finishing 2/3 of the lambs and 1/3 store, breeding cow policy there with the progeny from the cows, or the heifers anyway, those that aren't retained as replacements finished around 18 months before their second winter, and then steers that are taken through 2 winters and finished around that 300 kilo carcass. And in addition to the progeny generated on farm, the farm also buys in about 60 to 70 weaner steers, bought in as weaners and taken through, excuse me, to around that 300 kilo carcass. So farm is stocked around 8 stock units per hectare. And in a typical year, there's no cropping, no nitrogen fert applied, and no supplements purchased. So hopefully that gives you a bit of an overview of our typical farm. So we'll move into the 1920 season just finished to do a bit of a debrief on what happened. So as far as the climate, I mean, Phil has explained the impact there. What I thought here is I would just pull up the graph which shows the pasture growth. So this has come out of FarmX from one of the monitor farms, and I thought it illustrated the impact quite well. So 1920 is our red line, and we can see we had good growth through the winter following the previous summer's dry conditions. Good growth through spring, and then we can see by December things were drying out, and we can see that growth coming back drastically. And then from February, March, April, again, yep, we're into sort of drought conditions, and for this particular farm, they grew about half the growth they normally would. And positive it is really through May and June that we see that growth responding once we do get that rain, and we've seen some excellent winter growth rates, which certainly have helped farms recover. So the implications on, by the way, this photo is taken in February, last photo was taken in November, both around the King Country area. So you can see just visually the impact the drought had. So the implications, this summer was a widespread drought. The previous summer was more localised. So that had some wider reaching impacts on the store market, and obviously store prices were depressed. COVID, so we did see a significant processor backlog, especially through level 4, with beef chains running at 50% of capacity and lambs at 75%. So that created a perfect storm on farm, really, the dry conditions with farmers needing to offload stock, and then the limitations on killing stock thanks to COVID. So what's been happening on farm? So breeding cows held on through the summer all right. There was a bit of feed on the hills for those cows to keep them growing, keep them going, but that is gone now. Ewe condition was generally lower, and especially in the two-tooths, with a number of clients seeing a larger tail end in the ewes. And finishing cattle were sort of 20 to 30 kilos lighter going into the winter. So going into winter, a number of farms did reach for nitrogen to boost that autumn growth, to sort of build covers. But I guess the big point I'd make here is the management response did vary between farms. Some farms did make early proactive decisions with the drought, and they were able to protect the performance of their capital stock, like their ewes. They managed to build feed in the autumn, and they actually positioned themselves very well and were able to take advantage of some of the cheaper prices coming out of the dry conditions through May and June. So on to the financials for 1920. So cash-wise, and all of these comparisons are against the 18-19 year. So net cash income sort of up 2%, so pretty stable compared to 18-19. Sheep income up 4%. Drivers there was sheep down 4%. So driver there was more lambs sold store and the lower drought pricing and also the lower wool returns. Cattle was a game of two halves. So pre-Christmas, as we saw on the schedule pricing, we had some phenomenal prices around. And then as we into summer, we were into depressed prices. So for our model farm, it does sell some cattle pre-Christmas and some post. So we did capture both sides of that fence. With the drought, the model farm did sell more stock and less stock were purchased. So it's a combination of factors sitting behind the cattle that increase in cash income. Farm working expenses was pretty flat, really, down 1%. Big drivers there were animal health, so less challenges with fly and feed over summer. Plus, we're seeing a lowered use of capsules. Feed costs, so it's through the dry conditions up significantly there, but at $5,500 spent, it's still not a big ticket item for our hill country farm. Fertiliser, so up there, drivers there was more nitrogen through the autumn, and in some cases farmers were swapping from reducing phosphatic fertiliser use in favour of nitrogen. Fuels and vehicle down 8%, so lower fuel costs through later in the year and lower vehicle use thanks to COVID. R&M down 5%. Had a number of farmers reporting that they're moving on to smaller projects, so just reducing the spend there. Debt servicing, so that's a big reduction there, down $26 a hectare. And driver there really is we've dropped our interest rate on our model farm from 5% to 4% on term debt and held overdraft at 7%. So net result, farm profit before tax was up 4%, or up $4,000 total. So in absolute terms, the farm made a profit of $112,000, or $183 a hectare. So very similar to the previous year. Moving further down, so tax was up 7%. So you earn more money, you pay more tax. Capital purchases, so a bit more money spent on capital there. Principal repayment, so good to see a principal repayment of $40,000 for the farm, and cash surplus basically at a break-even point of minus $1,000. Principal repayments of $40,000, that was equivalent to about 75% of a 20-year table mortgage, so we can see the farm is sort of close to a maintenance level. So going into 2021, and where do we sit now, and the impacts for the year ahead. So pasture covers, they recovered well through May and June, especially on the easier country, still quite short on some of those steeper areas. Ewes, so we're scanning results have generally been down, sort of in the range of 0 to 20%. There has been some large drops that we've heard, and other farms have managed to protect their ewe performance. So for the model, we've adopted a 3% reduction in scanning. Finishing cattle, as I've said, went into winter lighter, but are doing good weight gains now, thanks to the good pasture growth. Cow condition, they were sitting okay, and we're expecting a similar calving percent to last year. And as we've flagged, cattle numbers were reduced going into the winter, and that combined with the lower schedule outlook for the year ahead will have some implications, which we'll unpick. So for 2021, what are we forecasting here? So cash income, looking to be down about 22% or $200 a hectare. Drivers behind that is sheep, down about 20%. which is due to a combination of lower scanning percent, lower land returns, and lower wool returns. Cattle, again, down 27%, which is due to the lower number of cattle wintered. So that means less for sale this coming year. Lighter weights and the need to rebuild numbers for next winter. Farm working expenditure, so that has been cut down 6%. Major changes there is the labour. So a small lift there of 4%, which is due to lifts in the minimum wage and just budgeted increases for permanent staff. Fertiliser, that's a pretty marginal decrease really, so it was good to see that farms are still budgeting to continue with fertiliser. Fuel and vehicle, down on the expectation of lower fuel costs. Weed and pest and R&M, probably two of the more discretionary items that with less income, less money budgeted to be spent on those. Interest, so we're using pretty stable costs there, maintaining the same 4% rate on term debt and 7% on OD. So net result, sort of farm profit before tax is down significantly. So absolute terms would come from 112,000 the previous year down to 48,000 profit for 2021. So we make less money, we pay less tax. So in the budget, there's nothing budgeted for capital purchases, farm development or principal payments. And even with removing those sort of capital items, cash deficit, we are looking at $29,000 deficit for the 2021 year. So looking at some longer term trends for our model farm. So blue is our net cash income. So we can see that has been trending up through to 1920 and then taking a hit through 2021. Farm working expenses, similar trend really, has been rising and then plateaued. Farm profit before tax, same deal really. And then we have our yellow, our farm surplus for reinvestment. And we'll unpick this one on the next slide. So we have the same yellow farm surplus for reinvestment, and then where that surplus has been reinvested. So we can see of the 5 years we have, that the last 4 years we have been able to spend money on capital. 2 years, or the 2 most recent years for debt repayment. Last 3 years on development, and then we see our net cash position sort of coming down, and obviously 2021, the cash deficit we have talked about. So looking at the farm working expenses as a percent of net cash income on the left-hand side. So we can see we're averaging about 60%, so similar to what Phil talked about on the dairy side. But the concern is when you draw the dotted blue line, that farm working expenses appear to be increasing at a greater rate than our income is. And with the 2021 drop in income, then that is increasing farm working expenses as a proportion of income. So the graph on the right is our return on capital. So we've been sitting around that 1.8%, with the exception being our 2021 year, where we are certainly down there. So positive with our return on capital is our land values. So land values do continue to firm. Sales we're seeing are mainly farmer to farmer, and yes, there is some speculation on the carbon forestry. For our model, we've adopted a 5% lift in land value for the 2021 year. So to summarise our financial position, so 1920 was very similar to the previous year, really. You know, cash income, farm working expenses, very similar. Good to see the farm has been able to spend money on development, capital and debt reduction, and after covering those items, our cash result has been neutral. For 2021, the outlook isn't as rosy, with the lower schedule outlook, lower stock numbers wintered, lighter weights, lower lambing percent. This does have some impacts for the year ahead. And as a result, we're not budgeting on any development capital or debt reduction, and even with that, still looking at a deficit. As I've said, land values, there is a positive there, and there is still quite a bit of optimism looking at the longer term. We still believe that, I guess, the schedule outlook is positive once we can get through COVID. We still have the impact of the African swine flu and I guess the demand that creates for other proteins in China. So moving on to other issues. So look, Phil has covered the Waikato Plan Change 1, and similar story really for fish eating beef farms. There is a lack of understanding, which is in part thanks to the submissions and appeals process. So as we know, it will be going through the courts. Actually, for healthy waterways, again, not a great understanding there. But really what these two items mean at the farm gate is that there is a potential to restrict how farm operates, and it is going to be increasing compliance costs. There is a positive here that, especially for Plan Change 1 for sheep and beef farmers, the removal of the grandparenting through the commissioner's process was a real positive, and that is a win for sheep and beef farmers. Greenhouse gas emissions, so that's coming very quickly. We have Hirokariki Noa charged with developing the pricing and accounting mechanism, with all farms to be using this mechanism by 2025. So that is around the corner very quickly. Phil's touched on the prospect of the third dry summer in a row, and I think that the saying, plan for the worst but hope for the best, comes to mind on that one. COVID-19, we've talked about the impacts on overseas markets and really the uncertainty of how long that will impact, especially the restaurant trade. And then the secondary there is there has been some challenges accessing labour for the likes of scanning and sharing. So there is a positive out of COVID though, that it has improved the public sentiment towards farming. And I think a lot of farmers are feeling quietly proud that they sort of are being recognised as an important part of the country's economic rebuild. So the final point I'd like to make with our sheep and beef model is it represents a typical sheep and beef farm. There are farms out there doing very good performance. So I think as an industry, there is the opportunity for us to lift our game. And also considering the compliance costs, I think there is the need to lift our game. Right, so I think we'll open it up for questions. No?
Okay. So if you've got any questions, viewers, please flick them through now. Phil, maybe one question just to start off. One of the questions we often get is, it's a relatively small data set. How does it compare to more larger data sets and surveys and the historical trends? I know you've done some analysis work on this.
Yeah, thanks, James. Yes, in one sense, it is a small data set, and we use various mechanisms like the industry meeting and a statistical model to work around that. Usually I compare our data back with the Dairy NZ Economic Survey when it comes out, which I've just done recently. Just looking at two key indices, if you like. The first was gross farm income, net cash income, whichever you want to call it. Over the last, I think it was the 8 years, the difference between us and Dairy NZ was 4%. The second industry was looking at our farm working expenditure per kilo milk solids, and again the difference between us and the Dairy NZ data was 1%. So I'd have to say I think that's pretty good. And what it does show, if you compare the two on the graph, is we follow the trends quite closely, and I guess the advantage, if you like, from our viewpoint is, given that we're looking, forecasting year ahead and all the rest of it, we're tending to pick the trends very well.
Phil, another question. Sorry, guys. Another question or comment, really, Phil, is farm working costs have crept up to around 60% of farm of income. So, and I see this year it was $4.54 per kilogram milk solids farm working costs. We're forecasting to go down to $4.19. And within that, I note that feed costs are around 30% of our farm working costs. So it's an interesting trend, and I suppose we've got a survey saying, hey, we're going to drop down to $4.20 of farm working costs. Is that achievable?
Well, there's a number of factors that come into play there, if you like. Obviously, your farm working expenditure fluctuates year to year. It's largely a function of income, if you like. Normally, the higher the income, the higher the farm working expenditure. There's also another factor in there, in the sense that if you look back over the last 2-3 decades, our farm working expenditures have just kept increasing, and that's a reflection of on-farm inflation, which runs 2 to 3 times higher than the CPI. So if you like, farming in New Zealand, and it's been the case for a long time, people, it's not a new phenomena, is that we just have to keep running to improve our productivity in order to sort of stay ahead of the game. And partially that comes back to that break-even payout that I was talking about. And as I mentioned, in essence, we really need around a $6 payout to break even in terms of the business, and plus $6, for capex and debt repayment and all that sort of thing. As I showed in one of the slides there, the average within season payout over the last 10-15 years now has been around $6.11. So we're only running just ahead of the pack, if you like. But coming back, can we achieve $4.20 farm working expenditure this year? Simple answer is yes, we can, but it all depends. If the payout improves, and I just note that most of the banks are forecasting a higher payout than Fonterra has announced. If we get a higher payout, then the farm working expenditure will go up. And I think if 2015 proved anything, when the payout crashed, farmers did reduce their farm working expenditure, although that was to a point where they were what I would argue is a sub-sustainable expenditure level.
Thanks, Phil. And just to add to that comment, in the survey results, we tend to see a very wide spread in farm working costs, don't we? With some farms still achieving sub $4 cost structures, and many over $5, unfortunately.
Yes, indeed. I can't recall the exact figures, but I think the range from our monitored farms is in the order of around $3.50 to probably around $5.50. So a big range.
Yeah, so what sort of moisture levels potentially are currently down at the moment within the survey group? What were if were strategies that some of those group members have considered for the coming summer to mitigate their?
Well, I think obviously we can't unfortunately do much about rainfall. I think the key strategy really for the monitored farmers was looking to rebuild their supplement levels. As I mentioned, going into the winter, they were well down in supplement, although they most felt they could get through the winter, early spring all right. But I think the emphasis is going to be on rebuilding those supplements in the spring. If you can't make it on farm, then they'll look to buy it in. The indications are that there's strong demand to contracted maize. There's some indication that the maize area will go up this year. And then, of course, you can buy supplements such as PK. And I haven't got any handle on how contracts are going at the moment.
I might comment on that one for the sheep and beef side as well. So I'd almost break it into two periods. You've got the pre-Christmas period, where a lot of guys are saying, well, we really need to maximise performance on our sheep. So we need to aim to get as many lambs away as we can pre-Christmas, because if it's going to go dry this coming summer, then we need to be destocked. So there's a small positive that farmers have said, well, with the lower scanning percent, we have more singles, so we might get a better lambing weight, weaning weight. Yeah, you can take that as a positive if you want. Cattle weights, so again, we've said cattle weights are down. So some of the guys are discussing, do we accept lighter weights and stick with selling at the same time, i.e. pre-Christmas? Because there's going to be the temptation to chase the same weight and chase the cattle further into summer. So time will tell on that one what happens. And then once we get into summer, it is certainly a case of sort of getting the farm set up, having trading policies so the farm has the flexibility to accommodate dry conditions, and really with the aim of protecting the capital stock on the farm, being the sheep and the cows.
And I think just coming back to dairying for a moment, you know, as I've indicated, the financial position of the farm going into this new season looks good. We've worked on the Fonterra forecast of a 640 payout. So all things being equal, most farms should have the cash to buy in supplements if they need to.
Thanks, Phil. Clint, if there's no further questions, we'll call it to a close. Team, have you got any final comments before I pull it together?
No, I think, yeah, on the sheep and beef side, the budget for the coming year isn't great. And working through that budget with clients, there was a little bit of, I don't really like that outcome. So I really encourage people to be encouraging their clients to do those budgets and to start that planning process. Yeah. Longer term, we still believe there is a lot of optimism out there. So it's just sort of getting through to that point. Yeah.
Thanks, Steve. And Phil, any closing comments from the dairy side?
Well, not really. As I say, we've had 2-3 reasonable years. 2021 looks as though it's stacking up to be another reasonable year, financially, that is.
Thanks, team. And just to reiterate to our viewers there, the information will be available on the AgFirst website, if not today, certainly by tomorrow morning. Both the reports themselves, which you've seen, and the presentation from today. So we trust you've enjoyed the session and look forward to having discussions with you about this throughout the year. Thanks very much.